Atlanta Fed President Raphael Bostic said that there's no rush to cut rates. And in a speech last night, he said that the evidence from data, our surveys, and our outreach says that the victory is not clearly in hand. And it leaves me not yet comfortable that inflation is inexorably declining to our 2% objective. And joining us now to talk about this is Steve Brown of Guggenheim Partners Investment Management and Carissa McDonough of Community Bank. Steve, when you looked at the inflation data coming out this week and just this morning, did it concern you much?
We're not trying to get too caught up in the month-to-month variation in the data. We acknowledge that there's likely to be some seasonality issues, particularly as we're starting the year. What we like to do is zoom out, as you did on that first chart, and look at the direction of travel. The important thing is that inflation is coming more in line with where the Fed wants it to be. And even more importantly, the Fed over the last 3 months, since you showed that recent bond market rally, introduced the idea that they can do insurance cuts or cut before they're at target. So to us, it's more about the direction of travel, and we're not trying to trade around the day-to-day to month-to-month, but expect continued volatility. But you have really high yields to compensate you for that volatility. So we think it's a good time to be investing.
Carissa, what does the inflation data say to you, and do you worry about a reacceleration of inflation at this point?
Yeah, thanks so much. We are actually not super concerned about a wholesale reinflation acceleration, and the reason being a lot of the persistency that we've seen has been in the services data. We actually think that's a bit of a catch-up from, kind of coming back from COVID and a normalization. So we actually expect, a lot along the lines of what Steve said, this is a really good time to be looking at long-dated bonds. The Fed, again, is not going to be hung up on any one or two inflation prints. We know that the data has been incredibly mixed. We saw very weak retail sales, factory orders. So a couple of inflation prints, while they're concerning, they're going to be taken kind of the broader context. So we don't think that we're headed for higher inflation at this point.
Steve, what do you do when you see a bond sell-off like this? So, we've definitely seen a significant move from 447 at the beginning of the week on the 2-year to 467. That is 20 basis points. I mean, do you see these as buying opportunities, or does that volatility worry you?
It doesn't worry us on a day-to-day. We're thinking about the current environment much like last year in that it's range-bound. So we believe we're at the upper end of ranges for yields, particularly as you cited for the 2-year part of the curve. What you want to do is look out to what Fed expectations are for the terminal rate. And so now with the recent backup in yields, we see the terminal rate the market's expecting is closer to 4 or in the high 3s. Frankly, we think that's a buying opportunity because the Fed themselves likely think that they're going to get back into the 2s. We're more in the low 3s camp, but we've overshot the recent ranges, and so we would be tactically adding within these range-bound yields that we're expecting for the year. And importantly, carry should ultimately win out. Last year was a year where you saw a lot of volatility under the surface, but when you zoom out, interest rates were essentially unchanged on the year. Now we're in an expectation where you could have rates higher for an interim period, but on balance, we think they should be generally flat or biased to move lower.
Carissa, how do you feel about positioning further out on the curve at this point?
This is an excellent opportunity to do so. Anytime we see a sell-off, we are adding on the long end of the curve. We're looking at 10-year yields in excess of 4.20, 4.25. Absolutely an opportunity, especially when you're comparing it, as has been talked about, the expected long-term or terminal rate. We think that a more normalized area would be in the 3.5% for long-term rates as we go through a market cycle. So this is completely the time to be adding duration. There's a lot of different portfolio strategies that you can engage in that would benefit from long duration. We are putting our clients into long duration anywhere possible. This is absolutely a great opportunity. I cannot emphasize that enough.
Wow. So Steve, do you feel the same way about duration, and how far out would you go?
So we partially agree. So our bias when we are adding duration is more towards the belly of the curve. Again, we think in an easing cycle, that's the part of the curve that tends to outperform. But we're primarily credit investors. So we're trying to add excess return through credit selection and sector allocation decisions. And so when we talk about credit, we do think we're in a good environment right now. While valuations are not as cheap as they were, say, 3 or 6 months ago, when you look at the all-in yields, the baseline yield plus the spread, you still have a lot of total return opportunity and a significant amount of income. You can generate portfolios that are diversified in high-grade assets and getting yields anywhere from 6 to 8%. And if you want to take more risk, you can go and get 8 to 10%. So this is really an attractive time to be a fixed income investor.
Well, Steve, what do you prefer here? Do you prefer duration risk at this point or credit risk?
Credit risk. Duration risk is going to have a lot more noise and volatility to it. We would like to have some of these biases put into our portfolios and strategies where we can. But duration's been a low Sharpe ratio or volatility adjusted excess return tool over the last couple of years. While we agree with Carissa in that rates are biased to move lower, we think a combination of relatively safer, higher credit quality, longer duration instruments, while taking a little bit more credit risk and generating a lot of carry in the intermediate and front end of the curve is the right portfolio balance. Because what we don't want to be doing is taking a lot of additional fundamental credit risk in this environment. It's going to be a security selectors environment, but that's one where active managers should be able to prove their worth.
Carissa, how do you think about the rate cut environment moving forward? You've seen just this week a rapid repricing of expectations in swaps markets. Does it matter to you if the Fed is cutting 4, 3, or 2 times this year? What's the biggest difference that would make in your portfolio at this point?
You know, I think the general direction is more important than the magnitude. And to the degree that we see that the Fed is continuing to have that bias to either hold or start to stair step down, like we said at the outset, you know, a couple of cuts have now been priced out for this year. So we think the Fed's going to possibly look at June, take a break, look at the data, go to July. But again, I think the more important thing is that the absolute direction remains down rather than kind of magnitude or speed at which that they're cutting rates. And I want to go back to something that Steve had said on the credit side. We also agree that credit represents opportunity. You do have to be somewhat careful. We really like the bank space at this point. A lot of bank, like single A kind of holdco bonds are pricing in more systemic risk. We don't think that's accurate. We think there's some balance sheet issues possibly for some issuers, but that represents opportunity in kind of the bigger, safer names. So that's one place that we're also seeing value at this point.
You know, Steve, it's worth asking, too. There's been so many fixed income investors really waiting for the year of the bond to really start paying off.
Right.
And you see some of the losses that are sustained in some asset classes here in fixed income. What are the biggest risks to you at this point?
Well, I mean, I think a continuation of volatility intraday, intramonth, you know, introduces sentiment risk. You know, fixed income markets have broadly benefited from positive flows to start the year and in the back half of last year, and we think that'll broadly continue. So, you know, the direction of travel is very important. You know, of course, there are risks broadly across the markets. The longer interest rates stay higher, if we can acknowledge that they're relatively high now, the totality of the move in rates will start to catch up with some lower quality issuers. And so just being selective is the best way to be allocating amongst credit right now and acknowledging that not all issuers are the same, not all sectors are the same, and this is really where you need to be prudent in your credit selection, particularly given all the uncertainty, which is unlikely to abate. Think about a period where we're going to have less volatility in data or markets. It seems unlikely that we will square to that type of environment, so you have to be flexible.
We have to leave it there. Our thanks to Guggenheim's Steve Brown and Carissa McDonough of Community Bank.